Hello, welcome back to DESA lecture for Chapter 2 for Accounting 1211. We are going to be talking today and really just kind of building on what we did in the last chapter about transactions. We're going to kind of develop a different framework for how to look at transactions, something that we're going to use going forward. So the first thing we're going to do is really some procedural stuff. We're going to talk about what accounts are and talk about T accounts, and then kind of talk about journal entry form. And then we're going to get into really the heart of the class by talking about debits and credits. This is the place where a lot of students get jammed up in this class. And so it's very important that we kind of take our time and get through this and really kind of build a nice base for debits and credits. And then we're going to do a bunch of transactions, even more transactions than we did in the last chapter. So the first thing I like to talk about before we get started is why this process even exists. Why do we use journal entries? And the best way I think to look at it is look at the results from our last chapter. This is what, after we did our 9 transactions, this is what our report essentially looked like. This is what the results of all of our transactions were. And this is a pretty big, sizable report, a big, sizable document. And you can imagine that was only 9 transactions. Think about a business that does hundreds of transactions or thousands of transactions in a month or in a day or in an hour. This would be a very cumbersome process that would require a lot of space. Journal entries and the way that we're going to do accounting in this class, it's really elegant and refined and simple in terms of how it's kind of structured. And hopefully you'll see that by the end of the class today. You'll see that you may not understand it fully, you may not really 100% grasp everything, but hopefully you'll see kind of the way it's really just kind of simply done. Another thing to think about too is this accounting system was developed when there was no computers. This is a pencil and paper system that has been transferred to computers now that computers are so prevalent, but was developed for a different reason. All right, just some procedural stuff first. You don't really need to know this. There's not any questions on the exam that ask you what an account is, but this is a term we're going to use a lot, and I've already used it some. And so I do think it's helpful to define what an account is. It's basically just a record of all the things that occurred, similar transactions. So all of our cash stuff goes in the cash account. All of our accounts receivable stuff goes in the accounts receivable account. All the equipment stuff goes in the equipment account. In addition, we're going to use this thing called a T account, just as a way to visually show what's happening inside of an account. You'll see that as we kind of develop these journal entries. Just be aware that there's increases and decreases are going to be kind of flexible, and you'll see that too. This format you're going to see on your exam in terms of how to actually enter your journal entries. This is the space for your journal entries. If you're interested, you can buy paper that's designed like this for journal entries. Most of the worksheets that I have for you will have space like this for you to put your stuff into, for you to put your journal entries into. Now, let's get back to this and really get into the heart of what we're doing in this chapter. Debit equals left side, credit equals right side. So you may have already some preconceived notions about what the words debit and credit mean. You may have looked at your bank statements, or you may have worked at a bank or something like that. You may have believed that debit means increase and credit means decrease, or whatever you think those terms mean. You really have to eradicate that from your thinking. Debit means left side only, and credit means right side only. And so you can see on your screen, you have a T, what looks like a T, and on the left side, see where it says DR on the screen? DR is actually the abbreviation for debit. Don't ask, it's a long story. If you look it up on the internet, you'll see that there is really a little bit of a story to that. But that's the abbreviation for debit. And CR on the right side of the T is the abbreviation for credit. And so we have the debit side of this T account, which contains the assets, expenses, and dividends, and the credit side of the T account, which contains liabilities, revenues, common stock, and retained earnings. That RE means retained earnings. So what does this mean? What do these symbols mean? What does this put together for? So basically, this is just a shorthand way for you to see where the natural or normal balance of an account is. And so this is just a short way to kind of see that in action. So for instance, The natural normal balance for an asset is debit. The natural normal balance for expenses is debit. The natural normal balance for dividends is debit. And then on the other side, the natural or normal balance for liabilities is credit. The natural normal debit for revenues is credit. Common stock and retained earnings is credit. Hopefully you get the gist. And so what this is essentially just a shorthand way to see where those natural normal balances are for each type of account. And this is going to be very important as we continue on, because the natural normal balance for an account is where the increases are to that account. And again, you're probably like, what is he talking about? That's okay. You'll see more as we kind of move forward. So the next thing we're going to do is, this is where worksheet 1 comes in. Worksheet 1 looks a lot like our worksheets from the previous chapter. It's got those same accounts, only instead of writing asset, liability, equity, or income statement, balance sheet, statement of retained earnings, on this worksheet, I want you to write what the natural or normal balance is. Is it debit or credit? And so really you can just go back here and look at your sheet. You can just go back, take the video back, however you want to do it. But I think it's important for us to kind of put on paper what the natural normal balances are for the accounts. And I think hopefully you'll see why that's so important as you view video 2.